You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes, SD War Collection, to our exclusive new line of insurance, approved, TL-rated precious metal safes, SD Bullion is what you're looking for at the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the doc today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend, it's great to have you back in the show, Dave Kranzler from Investment Research Dynamics. Great to have you back, Dave.
Hey, it's great to be here. I always enjoy chatting with you guys.
Certainly had a big week in the markets this week. FOMC meeting on Wednesday. The Fed announcing they're going to be patient with rate hikes still here in 2015. And really, once again, as Eric and I warned on last week's show, we've seen a classic post-FOMC raid that began late Wednesday afternoon and climaxed on Thursday, and combine that with options expiry this week too. We had gold smash back through 1,300, almost down to 1,250, bounced to just above 1,250 on Thursday. Didn't have too much of a bounce, but did close the day right around 1,260. Silver had its worst day in about 18 months, I think, trading all the way down about $1.50 from pre-FOMC levels, around 18.20 and change, down to a low of around 16.75 here on Thursday. It did pop back above 17 just a couple of times, just barely, as we record this right around midnight on Thursday into Friday. It's trading right around that 17 level. What's your take of the action here today, Dave?
A lot of people out there connecting it with the FOMC meeting, and lately, like in the last 12 months or so, it seems like instead of smashing gold and silver ahead of the meeting, they wait until a day later. And I think part of that is that they're hoping that traders breathe a sigh of relief and jump in after the FOMC statement. They jump into gold and silver futures and get long again, and then the bullion banks go in there and plunge the market, which is obviously what they did. It started around 4 in the morning Eastern Standard Time last night. And there wasn't any specific news or events that would have triggered a sell-off in gold or silver. So, I mean, they clearly plunged the market. However, I think there's a different reason for why they did what they did. And obviously, we were talking about how they raised the silver margins today, and I'm sure they let word of that leak out ahead of time so that people who were worried about that would sell their silver and gold positions ahead of that news event at the end of the day. But most of the damage had already been done, and as you pointed out, the market started to bounce toward the end of the day. When I looked at tomorrow's first notice day for gold, for February gold, which means that anyone who's not is not funded to stand for, if they're long gold, February gold contracts, if they're not funded to stand for delivery, you got to sell your contract by the end of today. So if you're just a small-time trader and you've got a long position in Comex gold and your account doesn't have enough money to receive delivery tomorrow, you got to be out. And that actually, a long time ago, that happened to me once. I forgot to sell a bunch of silver contracts, and they actually sold them for me during the access market. And a lot of times what happens is if there's a relatively high degree of open interest in gold or silver ahead of first notice, you'll see the kind of action that we saw today, which was a market plunge. And so this afternoon I pulled up yesterday's open interest report, and I saw that there were 28,490 open February gold contracts as of the close of yesterday. It reflected all of yesterday's trading through the afternoon access session or Globex session. And that's close to 3 million ounces of gold. It's basically 2.8 million ounces of gold. Well, then if you pull up the Comex Metal Depository Report, it shows that there's only 767,000 ounces of gold that's registered, meaning gold that's available to deliver into the February contract if a high percentage of those open contracts decide to stand for delivery. In fact, it's about 3 times the amount, the open interest. So I'm sure the bigger motivation for plunging the market today was to try and knock down and force selling in the February gold contract so that they could get, the risk that a high percentage of what's left after today stands for delivery is greatly reduced, because I'm sure they forced a lot of sellers today. And the day before, the open interest declined by 56,000. So I bet you when we see tomorrow's report, I'll bet you another close to 20,000 sold. We may only go into first notice day with about 8,500 contracts open. And actually, if you look at the total amount of gold that's being shown in Comex inventories, and again, I think these numbers are dubious. I don't believe them. I think they over-report them. But there's a little under 8 million total ounces. So as of yesterday, the open interest just for February represented almost 37% of all the gold on the Comex. And to me, that's your motivation there for why they plunged the market, was to force sell weaker hands out of February gold so that there wasn't going to be a run on Comex gold during the delivery period.
Just to speculate, what do you think that says as far as April delivery period? Because, it's a traditionally larger month, and if they're having this much trouble to juggle, that suggests that April is going to be one heck of a tough juggling act for the cartel.
Well, again, it depends. I mean, the longs could potentially control what happens at the Comex if a fair amount would just stand for delivery. You got to figure the majority of those are hedge funds who are capable of doing that. Because if you look at, I said yesterday the open interest had bled off 56,000 contracts. Well, 44,000 of them rolled into April, and you're already at 284,000 long contracts for April. I mean, that's 28 million ounces of gold. That's 3 times, more than 3 times the amount of gold, total gold on the Comex. But the thing is, the people who go long, it's primarily speculators, and they never stand for delivery. If just yesterday's open interest for February if just half of those had stood for delivery, it would have broke the Comex, unless they would have made provisions to take gold from the eligible category, which is theoretically it's investor gold that's not available to be delivered. So, I mean, one of these times we will see a high percentage of the front month open interest decide to stand, and that's when it's lights out for the Comex. But who knows when that's going to happen? I've been waiting for quite some time for that to happen.
Well, the general backdrop as well, from a fundamental point of view, is just fascinating to watch, because, we've had gold rise along with the dollar over the last couple of months, and in other currencies worldwide, there pretty much isn't a currency cross with gold that hasn't seen gold go really high. I mean, euro, it's over 20% appreciation since the November lows, and we're not talking about crazy scenarios like what's going on with Russia and the ruble. It's the core money centers of the world where people are clearly moving in, trying to get covered, and there's a huge fear trade now going on, and that combined with this rising fear of deflation and the central bankers getting more aggressive, ECB taking the lead now in this rotation that we've talked about over and over again. It's interesting to see even the conventional finance world. I mean, I'm not talking about the guys that read Zero Hedge and consume anything but Wall Street Journal, Financial Times, whatever. I mean, it's clear that they're beginning to inch around the edges and take more interest in gold. I think also, too, we have a rising interest in Europe with, for the longest of time in this 2011 up until about, say, November or so, in this bear cycle that we've been in. Europe's been predominantly sleeping through this whole period, just like North America. And all of a sudden now, Europeans seem to be buying gold. So the conditions underpinning the gold market is definitely in flux and changing more to the upside. So I think that's going to put even more pressure going forward on the cartel's ability to keep a lid on things. I mean, you had written an article, forgive me, I forget exactly when you published it, but it was a few days back, maybe even last week, where you were talking about how you believe that the cartel is beginning to lose grip on the ability to maintain things. And I think that assessment's right on money. You want to talk about that a bit?
Well, I think the available above ground supply of physical gold that they have available to beg, borrow, and steal, I think that's starting to run kind of thin. You know,
yeah, even countries that they can take over and steal gold, that list is even shrinking.
Yeah, but those countries, I mean, if you look at like the Ukraine gold, I mean, what was it that they took? Something like 23 tons or 26 tons, whatever.
In the 30s. But it wasn't as plumb of a rich heist as like Iraq or Libya. Libya actually had quite a bit.
Yeah, but I mean, just last week alone, there were 70 tons removed from the Shanghai Gold Exchange. So that's what I mean. I think yeah. some of these most of the countries that have a significant supply of gold that the U.S. military can steal and give to the Fed to deliver, I think they're starting to run low on that. I think, to me, the interesting thing to watch is GLD. Now, I don't believe the inventory numbers for a second that come out of GLD, but let's just say even at face value, if there's still 700 tons in there, I mean, clearly they've been using the gold from there to put out delivery fires. There's no question in my mind. And I know a lot of people have been writing about that lately. So I just wanted to circle back really quickly. You made a good point about gold has been actually rising with the dollar this year. And I think maybe since mid-December or something.
Right.
But some of the best runs we've had during this 14-year bull market in gold have occurred. They've been preceded by a period when gold and the dollar move up in tandem. And I'm not saying it's going to definitely repeat this time around, but it certainly looks and smells like it might.
Yeah, I think it will, actually, because what's moving the dollar up now is kind of a synthetic run to unwind all these carry trades. In the third world debt, we have a lot of dollar-denominated debt that has to be closed out, and people are moving back into dollars, and it's happening with the euro cross with the dollar in particular as well now with the ECB. So all of these trends have been pushing the dollar up vis-a-vis other world currencies, but not for good reasons. It's not because the economy is strong. It's because of the goofiness and excesses of the credit markets basically coming under pressure, and concomitant with that, a growing appreciation among the so-called conventional Wall Street types that we've got major credit risk out here, and people are looking to gold as a way of hedging that bet. I mean, it's still very small in North America, what is probably still under 2% of net assets for financial assets vis-a-vis gold holdings. But there's only so long before all of this excess within the credit system can continue on, and I think, and I know that you agree, Dave, that we're definitely in the end game now, and it's just a question of how long it takes. I mean, I don't think we're going to get out of this craziness beyond 3 years, and it's probably going to be 18 months or less. And
hey, don't put words in my mouth. I never said the word endgame. Obama got on national TV, when was it, last week, and told me the economy's doing great.
Yeah, well, he came in, what was it, March 9th or 11th of 2009, when he came out and said, it's probably a good time to buy stocks now. I think it's actually March 23rd or something like that. And he nailed the bottom exactly. He's like, mainlining with Bernanke and coordinating the QE programs and whatnot, TALF and TARP and so forth.
I agree with you. We are in the process of some sort of end game here, and clearly, the degree of misdirection and lies being told to us by political and business leaders, and the desperation to keep the stock market from collapsing. To me, those are, and especially the desperation to try and keep a lid on the price of gold and silver. I mean, to me, that's the clearest signals that, they're doing whatever they can just to try and keep kicking that can down the road. And at some point, they're gonna lose the ability to kick it.
Yeah, and the very definition of being in an end game process is that you get less bang for your buck in terms of all of the juice they're putting into the financial system. Perfect example, that would happen today. The FOMC comes out with their announcement yesterday, and Yellen has to come out and make dovish noises about the longer-term prognosis for keeping low interest rates just to prevent the stock market from slicing through important support. It's just, this is lunacy.
Well, Eric, I wanted to ask you, on last week's show, we were discussing the probability of a raid on Wednesday, Thursday, and Friday of this week. In predicting that, you had thought that really the dip wouldn't last long, and that within a week or 10 days, gold and silver would have recovered most of the losses. Gold really doesn't seem to have broken down too badly today, finding support at least initially here at 1250, or a little bit above 1250. Silver took it on the chin a little bit harder. What's your outlook now for the short term? Are you still hopeful here that in the next 7 to 10 days both metals will recover most of their losses, or as we head into next week, overnight, Monday and Tuesday, are we in for more pain?
I wouldn't be surprised if we do a little bit of a bounce just because of the severity of the decline that we just went through. And we are recording today being Thursday the 29th. But then, I think it's going to take some time for this kind of damage to heal itself. But, second week of February, there's enough ongoing catalysts for people to continue to demand physical above and beyond everything else. And that's going to pull the market back up. Everything that is driving the gold market now, and silver in tow, is just getting more pronounced from a strong fundamental point of view. And on top of everything, I believe that we're going to see a lot of geopolitical risk coming into the market mid-February as well, because the situation in Ukraine in particular in the near term looks horrible. So, and then on top of that, this whole negotiating process that Greece is going to go through vis-a-vis the ECB, and what's going to happen now that the government has shifted is still up in the air. And so I think we're going to continue to see the same momentum that's been in gold and silver, and that there really hasn't been a lot of money that's moved into the sector. It's just beginning to price in, or to rather, better said, to reflect the shift in sentiment that I think is going on worldwide, that started in, ultimately when the oil turned over in June, July, and the acceleration of the appreciation of the fact that we're in a deflationary funk that really just can't be fixed, and we're buying time where the central bankers can kick the can down the road a little bit with a gigantic QE, and most recently ECB doing 60 billion euro per month. But the fact that you see Yellen come out and react to the markets basically having a hissy fit about not getting enough juice going forward, that nothing has changed. Everything's getting worse. We also have the issue of some $200+ billion of the most junkiest of junk bond financing in the oil sector, and the debt that's overhanging as well from even mid-level quality companies in the oil sector. I mean, it's in the tune of trillions of dollars. And if only 10 or so % of that goes bad, the dead bodies are going to start showing up, and the counterparties to all of that debt are going to start shaking, and the credit system is going to come under huge pressure. And I don't think we're going to get beyond May, where all of that is going to be a heck of a lot more visible. The first quarter will start being reported in mid-April, and so April through May, you're going to start having a lot more managers of money realizing just how bad the problem is. And I don't think really, even though it's addressed in the Wall Street Journal, Financial Times, et cetera, my sense is that I think people are still kind of clueless when it comes to the majority of money under management in the mainstream financial world, and that's potential black swan catalyst. So as those forces come further into focus, I think that it's going to create a continued acceleration for the bid of gold, first and foremost, and silver following in tow. So to answer your question point blank, I don't think it's going to take more than maybe 10 days like we were talking about originally last show. I still think that that's the case, even though we had such a big smash today.
I think if my theory that they're having trouble keeping a lid on gold and silver because of the pressure from the physical market, I think we're going to see a quicker bounce back than Eric's looking for. One of the things that a lot of analysts don't look at because they just don't get the data is what's going on in India. And India's coming back into the market big time as a buyer. And on days like today is when they buy a lot. And the reason why I know that about India is because we subscribe to it's a 3 or 4 times daily market update on the gold market. It's called John Brimlow's Gold Jottings. It's very expensive, but he compiles data that would be difficult to compile everything that he compiles the way he compiles it. I mean, you could do it, but it would cost money and it would take time. But India's starting to stir again. They kind of had a little bit of a hiatus there for the last few weeks, but they're starting based on the premiums that are being paid over spot gold. It's known as the ex-duty premium. So there's whatever the import duty is right now. I think it's 10% of the spot price. So it'd be the ex-duty premium. So it'd be the premium Indians are paying for gold over and above the 10% duty that's assessed. Those premiums are starting to go very positive again, and typically when those premiums go positive like that, it precedes a big move in gold. So, and I think silver too. I think once the market absorbs this margin increase implemented by the CME today, and that the market may have priced all that in already ahead of the actual news event, because it seems like that's what's been happening recently. Because I'm sure the CME told their best buddies at the bullion banks, given that all the bullion banks are on the board of the Comex, I'm sure they all knew it was coming. So I think any kind of intended effect from jacking the margins on the CME were priced in today, which means we probably could see a pretty quick bounce in silver. And silver was, I think that had to have been the best performing commodity year to date until today.
Yeah, it was.
Yeah, so to me, that's another indication that they're having a little bit of trouble because of pressure from the physical market. I mean, I think India imported, what was it, like 7,000 tons of silver last year or something. I don't remember the number off the top of my head, but it was an incredible amount of silver that they imported. So, and I'm sure none of the bullion banks anticipated that happening. And who knows what China's importing, because they don't release those numbers. We don't get to see those numbers. We only get to see part of what they're importing in terms of gold now, because they opened up Shanghai and Beijing and they don't report those numbers. We only get to see what gets imported through Hong Kong.
Yeah, and I was talking calendar days, not trading days. So, no later than the second week of February, midway through that week, I think we're going to definitely already be on a rebound.
We may rebound it all next week.
Yeah, I agree. So, Doc, are you seeing anything interesting from the retail point of view? How were the phones
today? The phones today on Thursday were just ringing off the hook. We had probably the biggest single sales day demand-wise in silver since, I would say, November 5th. As listeners recall, that was a big down day in silver, and we didn't have quite the volume that we saw that day, but definitely the biggest single day sales, both number of orders as well as volumes of ounces, as we've seen then and with the last couple of months. So, and demand has been steadily strong here to start 2015. Silver Eagle sales remain strong. The Mint, again, is continuing to allocate sales and actually has reduced their allocations. The Canadian Mint is continuing to allocate sales of silver maples. So retail sales remain very strong, but thankfully we don't right now have the level of shortages that we saw about a year and a half ago, and premiums are still very reasonable for those looking to take advantage of the big futures dips like we saw today.
Wow, you know what? I haven't looked at the Mint numbers in quite some time, but the Mint, I just wanted to compare it to last year's numbers for January, because usually January is a pretty big month because they pile a lot of December's coin sales and Silver Eagles into January. But
yeah, I don't think we'll see a new sales record this year in January compared to last year, as at least according to the U.S. Mint spokesman, they continued production a lot longer in December this year at the cost of January production. At least that's the story they gave.
You know what? I just noticed they're reporting 5.4 million Silver Eagles sold month to date for January, and last year for all of January they did 4,775,000. So they're already almost 700,000 ounces ahead of last January.
Yeah, it is 5.4 million year to date. We may get a few 100,000 more before the end of the month here. And yeah, it was actually the year before, I guess, that was the sales record, not 2014. You're right about that, Dave. So it has already eclipsed January of 2014 sales numbers with the Mint.
Yeah, I was actually surprised because I thought I had remembered an unusually amount of December silver pushed into January last year, but we're already ahead of last year's. It's about almost 15% ahead of last year with one more reporting day for January left. So that's kind of interesting. I don't know what you've seen in your business, Doc, but it seems like whenever they hit the market, Mint Silver Eagle sales start to take off again.
Yeah, it's not just the Silver Eagles. It's bars, rounds, maples, Philharmonics, everything.
Right, which you see all of that.
Every sort of physical silver imaginable. I mean,
of course, if you're Ted Butler, you'd say it's all JP Morgan. Oh, there's the buyers.
Really, I mean, what we were seeing today, it was the large majority of orders coming through today were for rounds. A lot of 90%. The 90% market starting to tighten up a little bit. It had been softening a bit over the last couple of weeks, but most of that available inventory was sucked off the market today. There's never really more than a couple of days supply of 90% if there's really a big demand run. So
a couple of times in the past you've noticed that there is a qualitative difference in the type of buyer with new people coming to the market periodically. Have you seen anything that suggests that there are new buyers of people waking up and saying, oh gosh, I need some precious metals? I mean, do you see anything in that regard?
Yeah, and I would say really over the last couple of weeks as silver has been running higher, I really haven't had time to look at the numbers and analyze the data for today yet, but over the last couple of weeks, I think there's been a lot of money that's been sitting on the sidelines waiting to see a bottom, and as they've watched silver bounce off at $14.50 and run a couple of dollars higher, are now entering the market, and we have been seeing a whole lot of brand new first-time buyers in silver, and a lot of them are making fairly significant purchases, at least for the average Joe in America. I'm talking like $50,000, $100,000, a couple $100,000 as a first-time investment in silver. It's certainly not an insignificant amount for most investors.
Yeah, maybe we should develop an index with that, dollar flow value based on first-time buyers per month would be really cool to know.
That actually would be.
I mean,
cool
it's anecdotal and whatnot because you're not the entire industry, of course, but still, it would be worthwhile information to track.
I agree. That would be cool to know.
We'll have you chair that committee, Eric.
Oh, great! Sign myself up. Yeah.
Yeah, good idea, Eric. Go to work on that.
Well, before we wrap up the show this week, any other thoughts, guys? Dave, with the market as we head forward to next week?
Well, I'll tell you. I think watching how this whole Greek thing unfolds is going to get really interesting because clearly they're going to cast their lot with Russia. It sounds like.
Been evident over the last 48 hours.
And clearly Russia's not suffering too much, or suffering as much as the media would want us to believe that they're suffering from the fallout in the price of oil, because obviously they've been buying an increasing amount of gold for their central bank, and they just offered to basically help bail out Greece if Greece asks for it.
Apparently, according to S&P, that makes their credit rating worth junk now, though.
I don't think they care about that. They don't have a lot of debt outstanding, sovereign debt outstanding. I mean, it's as a percent of their economy, it's not a lot of debt versus the United States, which obviously has, more than 100% of its economy outstanding in just sovereign debt, and that doesn't include the Fannie Mae and Freddie Mac debt that it now guarantees. So, I mean, I kind of laughed when I saw S&P downgraded Russian debt. I was like, well, okay, but Russia doesn't really issue debt. In fact, they paid a big slug of it down last summer.
Yeah. And decline in the in the ruble insulates them enormously because they're getting paid dollars for their oil.
Right, exactly. Well, to the extent that they're accepting dollars now for oil, I mean,
yeah, well,
they're trading with China in rubles and yuan, and I think they're trading with a lot of other countries now. I mean, they clearly do not want anything to do with the dollar.
Right, but the yuan has actually been going up as well. So
I mentioned this is kind of interesting. Yeah, the yuan has been going up against the dollar, but I mentioned to you guys earlier I did a blog post tonight, and I tried to link an article from the FT about Russian gold accumulation, and I didn't realize this, but the FT somehow has their links rigged, so at least I couldn't post them on a WordPress blog that's hosted by GoDaddy. But interestingly, and it was on the front page of the FT, they featured an article talking about how Russia bought a record amount of gold last year. In fact, they bought more than any other. The Russian central bank bought more gold than any other central bank out there last year. And they specifically said that Russia has a program of divesting itself of dollars. And I thought that was really interesting because up until that point, we've only been reading it kind of in our corner of the world, like whoever, writes the types of blogs that we traffic on, it was all over the place, in terms of what Russia's doing with the dollar, but it wasn't getting mainstream media coverage, and this was on the front page of the Financial Times. I thought that was interesting.
It certainly is.
So I guess anyway, to kind of summarize, for the next week, I think watching the Greece thing unfold is going to be interesting, and I mean, there's been a few companies that have reported sort of gap manipulated earnings beats, but most of the large industrial and technology companies are reporting horrible numbers for their fourth quarter. So I think we're going to see a lot more reports about the continued deterioration of the U.S. economy, despite what Obama wants us to believe. And I think that'll be interesting to watch.
All right, well, we'll wrap this week's show there. We have Eric looking still to see gold and silver recover within the next 7 to 10 days, and Dave thinks that maybe even sooner. So we keep our eyes on the markets next week. I certainly wouldn't be surprised if both of you are correct. Certainly if the previous 10 to 15 FOMC meetings in the post-FOMC takedowns are any indication, as we move into Friday, we should see a nice bounce both in gold and silver. Again, if previous history, recent history is any indication. So.
Yeah, and we really should just take an extra minute. Just if there's new people that are listening to our conversation, you come into the market after having looked around and come to the conclusion that all doesn't seem right. It isn't right. And we debate about whether or not we're going to see a bounce within 7-10 days, whatever. The realities are such that the financial pyramid of debt is so great at this point, and the amount of bull that is being spun by governments all over the world. I mean, every single market is massively manipulated. All economic statistics, for the most part, are totally manipulated. And we're sitting at a juncture now that basically is going to be a monumental shift on the order of much larger than what we went through in 2007, 2009. So, welcome new people and check out the markets, because only one of the very few places you can hide is precious metals. And, it's now more so than I think any time in this entire bull market period important to have exposure to precious metals, because we're literally talking about things that can cascade that take down the entire monetary system and the entire financial system in tow. I've never seen anything like this before. The level of insanity that is in our world now, and the amount of denial from the mainstream in reflection of it. It's just astounding to me. Very dangerous times, and then when you layer on top of that all the geopolitical nonsense, which is directly related too, because part of the whole shaking of the geopolitical front is there are three pillars of international relations power. It is economic, moral authority, and military power. And as the United States empire kind of unravels at the seams because of our financial situation, we exercise one of the last pillars of power that we have more so than the other two, and that's military. So it's very dangerous times. I think 2015 is going to see a lot of turmoil. It may not be the ultimate end game in 2015. I kind of tend to think that it will not be, but the amount of crap that's going to hit the fan this year is just it's really kind of depressing.
And on that note,
sorry.
On that note, we'll wrap the show for this week. Yeah, Dave, great to have you back as always.
Hey, just real quickly, what Eric said about it being depressing, it's just a matter of your state of mind.
Yeah.
I mean, we've been forecasting, economic Armageddon for a while now, so there is some sort of satisfaction in being right when it actually really, when the stuff really hits the fan, right?
Yeah, and to end on a positive note, when people begin to wake up and realize all the lies that have been told, and they start asking questions of why things happened and who did what, what policymakers set up, we could conceivably have a reformation, a rebirth, where political systems become more democratic in their nature, and people demand of their government. I mean, right now, most people in America aren't even paying attention. They're consumers. They're not citizens. And if things shake down quite strongly, there is a tendency in American history over the last hundreds of years that when bad things happen, people do pull together, and maybe we'll have something positive come after all of this craziness, and I do hope that will be what we see.
All right, Dave, thanks for joining us. Always great to have you back with us.
Thanks for having me. Always enjoy talking with you and Eric.
All right. Thanks for tuning in. For the Doc and Eric Dubin and guest host Dave Kranzler, thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They use the word orderly. As long as it's orderly, it seems to be okay.